Imagine turning $500,000 into a fortune. What would you do first? Invest it or pay off debt? The choice could define your financial future. David Tepper's strategy isn't about luck. It's about discipline, timing, and thinking like an owner. Today, we break down the decision every investor faces. Most people panic when they face debt or investment choices, but the smartest investors know there's a method to the madness. David Tepper's approach teaches us to act decisively, weigh risk, and maximize opportunity. In this video, you'll learn exactly when to invest and when to eliminate debt, step by step. David Tepper's success didn't come from luck or guesswork. It came from preparation, knowledge, and a clear understanding of every decision he made. When it comes to money, Tepper never jumps in blindly. Every move he makes is backed by careful analysis, meticulous planning, and an awareness of both opportunity and risk. Before committing a single dollar, he assesses the full picture, how much debt exists, what the interest rates are, what the potential returns could be, and how all of this fits into the broader financial landscape. He knows that acting without understanding is a recipe for failure. Clarity is power, and Tepper treats it like a weapon. By knowing exactly where you stand financially, you remove uncertainty and reduce fear. For example, understanding your debt means knowing the exact balance, the interest rate, and the minimum payments. It's not just numbers on a statement, it's the foundation for your next decision. High interest debt is dangerous because it grows faster than many investments, but low interest debt can sometimes be leveraged strategically. Tepper evaluates these nuances before deciding whether to pay off debt or invest. He doesn't make decisions based on emotions, trends, or peer pressure. He makes decisions based on facts and analysis. Interest rates are another critical piece of the puzzle. Tepper looks at them closely because they determine the cost of holding debt and the potential gains from investing. If the interest on debt is higher than what an investment could realistically return, paying off that debt becomes the smartest financial move. Conversely, if borrowing costs are low and investment opportunities are strong, it may make sense to invest first. Tepper's approach is never one size fits all. It's situational, dynamic, and always informed. Potential returns are equally important. Tepper doesn't chase flashy, risky investments just for the thrill. He looks at the risk-adjusted returns, the long-term growth potential, and how the investment fits into his overall strategy. Every decision is about maximizing the probability of success while minimizing unnecessary risk. This principle applies not only to investing, but also to financial decisions like debt repayment. By quantifying the impact of each action, he ensures that every move contributes to building lasting wealth rather than creating temporary relief or excitement. Ultimately, Tepper's insistence on understanding the full picture teaches a vital lesson. Clarity isn't just helpful, it's essential. When you know your financial position inside and out, you can make decisions with confidence, act decisively when opportunities arise, and avoid mistakes that come from ignorance or impulse. Tepper's philosophy proves that preparation and knowledge are as powerful as capital itself. The more you understand your debt, interest rates, and potential returns, the more control you have over your financial future, and the closer you get to thinking like one of the world's most successful investors. If your debt carries a high interest rate, paying it off is often one of the smartest financial decisions you can make, and David Tepper's approach to money underscores exactly why. High interest debt, such as credit card balances, personal loans, or certain types of consumer debt, can grow faster than most investment opportunities can generate returns. In other words, the longer you carry that debt, the more money you are losing. Tepper, a man who built his fortune through strategic risk taking, understands the power of certainty. Unlike speculative investments that carry risk, paying off high interest debt guarantees a return. The interest you would have paid is effectively money back in your pocket. This guaranteed benefit is something even the most successful investors respect and prioritize. When evaluating high interest debt, it's important to understand the math. Suppose you have a credit card with a 20% interest rate. Paying off $10,000 of that debt is equivalent to earning a guaranteed 20% return on an investment, something extremely rare and legitimate low-risk investments. Many stock market returns average around 7-10% per year over the long term, but paying off your debt removes a 20% annual cost immediately. Tepper's approach emphasizes that certainty should never be underestimated. While it may be tempting to chase higher returns in volatile markets, eliminating guaranteed losses first is often the most rational move. High interest debt also carries psychological and strategic implications. It's not just the numbers, it's the pressure, stress, and limitations that debt imposes. Tepper knows that financial decisions are never purely numerical. They are also about mindset and freedom. Paying off debt immediately frees up mental space, reduces stress, and allows you to focus on wealth, building opportunities without the constant burden of interest compounding against you. It's a foundation of financial power. You can only take strategic risks effectively when your baseline is secure. Another critical aspect is compounding. Debt with high interest compounds against you, meaning the longer it exists, the more it grows. Investments, on the other hand, compound in your favor. Tepper respects compounding in both directions and knows that eliminating high interest debt first ensures that the compounding effect works for you rather than against you. By reducing your liabilities, you effectively accelerate your path to wealth creation because every future dollar you earn or invest now has less drag from interest costs. Finally, this principle illustrates Tepper's respect for certainty in financial decisions. He doesn't gamble with money he can't afford to lose, and he doesn't ignore the guaranteed benefits of paying off debt. High interest debt is one of the few scenarios in finance where action produces a known, immediate, and measurable benefit. It is low risk, high reward, and strategically powerful. For anyone looking to emulate Tepper's mindset, recognizing that paying off high interest debt is essentially a guaranteed return is a crucial lesson. In the end, it's not just about earning. It's about protecting and maximizing what you already have. Certainty, discipline, and clarity are at the heart of Tepper's approach, and eliminating high interest debt embodies all three. David Tepper's approach to investing is not about chasing quick wins or gambling on luck. It is about long-term control, deep understanding, and strategic influence. He invests with a mindset of ownership, treating each investment as if he were acquiring a piece of a business or an asset that he can truly understand, manage, and influence over time. Tepper recognizes that true wealth isn't built by momentary speculation, but by carefully positioning oneself where knowledge, control, and foresight intersect. This principle is crucial for anyone trying to grow their wealth sustainably. When Tepper evaluates an investment, he doesn't simply look at projected returns or market hype. He analyzes the underlying structure of the asset. He asks questions like, do I understand the fundamentals? Can I predict how external factors, like economic shifts, regulatory changes, or market sentiment, will affect this asset? Does the investment give me any degree of control or influence, whether through ownership, strategic decision-making, or timing? Tepper's philosophy is rooted in the idea that the more you understand and can influence an investment, the more likely you are to generate consistent, long-term returns. Focusing on assets you can influence is a key differentiator between amateur and professional investors. Many people buy into trends, fads, or speculative opportunities because they see others profiting. Tepper avoids this trap. He recognizes that when you lack understanding or control, you are at the mercy of forces outside your influence, market swings, rumors, or the decisions of others. By investing in assets where you can actually impact outcomes, or at least fully understand the variables, you minimize risk and maximize the potential for strategic action. This mindset turns investing from a game of chance into a calculated strategy. Long-term control also allows Tepper to act decisively when opportunities arise. Because he understands the asset deeply, he can anticipate problems before they arise, and he can make bold moves when others hesitate. For example, during market downturns, Tepper has historically capitalized on fear-driven sell-offs, but only because he knew the fundamentals of the investments he was targeting. He doesn't gamble blindly. His control over knowledge and timing gives him a powerful advantage that most investors lack. Moreover, Tepper's strategy emphasizes patience and discipline. Long-term control means committing to investments that may take time to realize their full potential. Tepper is not swayed by short-term noise or temporary fluctuations. Instead, he positions himself in assets he understands, monitors them carefully, and acts decisively when conditions are optimal. This approach transforms investing into a strategic, high-probability endeavor where informed decisions and calculated risks compound into substantial wealth over time. In essence, Tepper's principle teaches us that investing is not just about buying low and selling high. It's about understanding, owning, and influencing. By focusing on assets you understand and can impact, you gain clarity, reduce unnecessary risk, and increase the likelihood of long-term success. Tepper's philosophy shows that the path to wealth is not speculation. It is informed, disciplined, and deliberate action. By thinking like an owner rather than a gambler, you transform every investment into a tool for building real, lasting financial power. Every financial decision involves trade-offs, and David Tepper understands this better than most. Every dollar you spend paying off debt is a dollar that is not being invested, and every dollar you invest is a dollar that is not going toward eliminating debt. This simple fact may seem obvious, but the real power comes from understanding the opportunity cost, the potential returns you gain or forfeit by choosing one path over another. Tepper approaches every decision with meticulous analysis, weighing which choice gives the best long-term outcome. He knows that financial success isn't about avoiding debt or chasing investments blindly. It's about making the highest return decision in every scenario. The first step is understanding the cost of debt. High-interest debt can compound rapidly, eroding your financial position. In such cases, paying down debt is effectively earning a guaranteed return equal to the interest rate. For example, if you have a credit card charging 20% interest, paying $100 toward that debt is the same as making a 20% risk-free return, something extremely rare in traditional investments. Tepper respects the certainty. He knows that eliminating high-interest debt often outperforms most speculative investments, and he makes sure the math is clear before acting. On the other side, investing has the potential to generate compounding returns over time. Tepper invests with an owner's mindset, focusing on assets he understands and can influence. These investments may carry risk, but they also offer growth opportunities that can far exceed the cost of low-interest debt. The key is comparing the guaranteed return from paying off debt to the expected return from investing. Tepper doesn't let emotions or trends dictate his decisions. He looks at the numbers, evaluates risk versus reward, and chooses the path that maximizes long-term wealth. Opportunity cost is not just about numbers, it's about timing and strategy. Tepper knows that paying off debt too aggressively might mean missing a market opportunity, while investing too early could expose you to unnecessary risk. That's why he analyzes each situation carefully. He considers interest rates, investment potential, market conditions, and personal financial stability. By doing this, he ensures that every dollar works as hard as possible, whether it is eliminating a liability or growing an asset. This careful evaluation also builds discipline and control. Tepper's method teaches that financial decisions are rarely binary. Paying debt or investing isn't about right or wrong. It's about context, timing, and the best use of capital. By systematically assessing opportunity cost, he transforms decision-making from reactive to strategic. Every choice is intentional, focused, and aligned with the ultimate goal of building long-term wealth. In essence, Tepper's philosophy shows that understanding the trade-offs between paying debt and investing is crucial. Each dollar carries potential, but that potential must be evaluated, measured, and directed where it yields the highest return. By thinking like Tepper, you learn to respect the balance between risk and certainty, short-term cost and long-term gain, making the right choice at the right time, informed by careful analysis, is what separates ordinary financial management from extraordinary wealth creation. David Tepper built his fortune not by following the crowd, but by acting decisively when others were gripped by fear. He understands a fundamental truth of investing: timing can change everything. While many people panic during market downturns or shifts in interest rates, Tepper sees opportunity. He knows that moments of uncertainty, when others are hesitant or selling in fear, can be the perfect time to invest strategically. This principle applies not only to investing, but also to the choice between paying off debt and putting money to work. Tepper evaluates the environment, identifies where risk is overstated, and strikes with clarity and confidence. Interest rates are a critical part of this equation. When rates drop, borrowing becomes cheaper, making it more favorable to invest rather than rush to pay off low-interest debt. Tepper carefully monitors these economic indicators, knowing that small changes in rates can shift the balance between investing and debt repayment. For example, if you hold a low-interest loan and the market presents an investment opportunity with expected returns higher than the interest rate on that debt, it may make sense to invest instead of paying off the debt immediately. Tepper's strategy is always about maximizing returns while managing risk, and timing is the key factor that determines which path provides the greatest benefit. Market conditions also play a huge role. Tepper famously capitalized on market panics, buying assets when prices were depressed and sentiment was overwhelmingly negative. Most investors shy away during downturns, fearing losses, but Tepper understands that The best opportunities often appear when everyone else is hesitant. By waiting for the right conditions, when panic drives prices below intrinsic value, he positions himself to achieve exceptional returns. This approach can be applied to personal finance decisions as well. Rather than blindly paying off all debt or investing at any time, analyze the environment. Is there a market opportunity that may yield higher long-term benefits than eliminating low-interest debt? Tepper's success shows that calculated risk taken at the right moment can transform your financial trajectory. Patience is central to this strategy. Tepper doesn't act impulsively. He waits, observes, and gathers information, knowing that the timing must be right. Acting too early can be just as costly as acting too late. This is why preparation and awareness of economic conditions are just as important as financial capital itself. By combining patience with decisive action, Tepper turns uncertainty into advantage, turning fear and hesitation into opportunities to create wealth. Ultimately, Tepper's approach teaches a vital lesson. Financial decisions are never static. They are influenced by market conditions, interest rates, and timing. By carefully evaluating these factors and acting boldly when conditions are favorable, you can achieve outcomes that others miss because they are driven by fear. Whether deciding between investing or paying off debt, Tepper's philosophy emphasizes clarity, courage, and the strategic use of timing. When the moment is right, strike decisively. The rewards can be extraordinary. David Tepper's approach to investing is legendary because it balances boldness with calculation. He is not reckless, nor does he act on impulse. Every move he makes is carefully considered, grounded in research, and aligned with a long-term strategy. Tepper understands that emotions are one of the greatest enemies of financial success. Fear, greed, and impatience can cloud judgment and lead to decisions that erode wealth rather than build it. That is why his philosophy emphasizes combining courage with preparation, a formula that transforms bold action into calculated, high-reward outcomes. Courage without preparation is gambling. Many people see opportunities in the market and rush in, driven by the fear of missing out or the excitement of potential gains. Tepper avoids this trap. He knows that acting without understanding the underlying fundamentals, risks, and probabilities is dangerous. Instead, he dedicates time to research, analysis, and scenario planning. He studies the economy, evaluates companies or assets thoroughly, and identifies where the real value lies. Once he has a clear picture, his courage allows him to act decisively, even when others hesitate or panic. Preparation provides the foundation for bold action. Tepper's meticulous research allows him to assess risk accurately and position himself advantageously. He examines balance sheets, market trends, interest rates, and broader economic conditions. This preparation gives him confidence because he is not acting blindly, he is acting with insight. When he makes a move, it is supported by data analysis and a strategic plan. This is what separates a calculated risk from reckless speculation. It is this preparation that allows him to embrace bold moves without exposing himself to unnecessary danger. Equally important is the ability to manage emotions. Tepper recognizes that panic and impulsive reactions can destroy wealth faster than any market downturn. He trains himself to remain calm, objective, and focused even during times of uncertainty. By separating emotion from decision-making, Tepper ensures that his actions are rational, strategic, and aimed at maximizing long-term gains. Courage in this context does not mean fearlessness. It means having the confidence to act decisively while understanding the risks and consequences. This combination of courage and preparation also applies to personal financial decisions, such as investing or paying off debt. Tepper's philosophy teaches that you should not avoid bold actions just because they are intimidating, but neither should you act without clarity. Evaluate your options, understand the potential outcomes, and then take decisive action. Whether it's making a strategic investment, consolidating high-interest debt, or leveraging low-interest loans for growth, the key is to act with both confidence and insight. Ultimately, Tepper's approach is a masterclass in disciplined boldness. It demonstrates that calculated risk, taking grounded in preparation and free from emotional interference, is one of the most powerful ways to build wealth. By blending courage with preparation, you can seize opportunities others miss, navigate uncertainty with confidence, and make financial decisions that create long-term success and stability. Boldness is powerful, but only when it is calculated. David Tepper's financial strategy demonstrates a deep understanding of how debt can be both a burden and a tool. While high-interest debt is a liability that must be eliminated, low-interest debt can sometimes be leveraged strategically to create wealth. Tepper views such debt not as a constraint, but as a resource, an opportunity to amplify returns when used carefully and intelligently. The key lies in understanding the balance between risk and reward and using leverage only when it increases opportunity rather than exposing oneself to unnecessary danger. This mindset separates successful investors from those who see all debt as inherently negative. Low interest debt offers a unique advantage because it allows access to capital at a relatively minimal cost. Tepper recognizes that if the cost of borrowing is lower than the expected return on investment, debt becomes a financial lever that can accelerate wealth creation. For example, taking a low-interest loan to invest in a well-understood asset or to purchase a business with high growth potential can produce returns far exceeding the interest paid on the debt. By using leverage intelligently, Tepper multiplies the impact of his capital, making each dollar work harder without taking on uncontrolled risk. The strategic use of low-interest debt requires discipline and careful planning. Tepper doesn't borrow simply for the sake of borrowing. He evaluates the potential returns, the risks involved, and the timing of the opportunity. He considers factors such as market conditions, cash flow, and liquidity, ensuring that any leverage employed enhances opportunity rather than creating vulnerability. Debt becomes a tool when it is used with precision and a full understanding of its implications, allowing an investor to seize opportunities that would otherwise be out of reach. Leverage can also amplify the benefits of compounding. By using borrowed capital to invest in high-quality assets or growth opportunities, Tepper can accelerate wealth accumulation. However, he remains vigilant, aware that leverage magnifies both gains and losses. That is why he applies it selectively, ensuring that each use of debt aligns with his broader financial strategy and risk tolerance. The goal is to enhance returns in a controlled, calculated way, not to gamble recklessly with borrowed funds. Tepper's approach to low-interest debt illustrates a crucial lesson. Financial tools are only as powerful as the strategy behind them. Debt itself is neutral. It can either hinder or help depending on how it is used. By approaching leverage with the same discipline, preparation, and clarity he applies to investing, Tepper turns what many see as a liability into an opportunity for growth. It is this mindset, seeing potential where others see risk, that underpins much of his success. Ultimately, Tepper teaches that money is not just about what you earn, but how effectively you deploy it. Low-interest debt, when used strategically, can multiply opportunity, accelerate growth, and create advantages that would be impossible through capital alone. The lesson is clear: leverage is not inherently dangerous. It is a tool. The difference lies in understanding it, respecting it, and using it in alignment with calculated, high-probability strategies. In Tepper's world, debt is not a burden. It is a means to expand opportunity, increase control, and achieve extraordinary financial outcomes. David Tepper's financial philosophy emphasizes not just seizing opportunities, but having the ability to act when they arise. One of the most critical elements of this approach is maintaining liquidity, having cash or easily accessible assets available at all times. Tepper understands that overcommitting to investments or debt repayment can limit flexibility and prevent you from taking advantage of sudden high-value opportunities. By ensuring liquidity, he positions himself to act decisively when the market shifts, interest rates change, or rare investments appear, turning what might seem like a risk into a strategic advantage. Liquidity provides freedom and optionality. Tepper never ties up all his resources in illiquid investments or overcommits to paying off debt at the expense of having a financial buffer. This discipline ensures that when a rare opportunity arises, such as a market correction or a distressed asset becoming available at a bargain, he has the ability to act immediately. Many investors miss these opportunities because their capital is locked in long-term commitments or fully allocated to debt repayment. Tepper's emphasis on liquidity is not about playing it safe. It is about creating the flexibility to act boldly and decisively when conditions are favorable. Maintaining a cash reserve also mitigates risk. No matter how well researched an investment is, markets are unpredictable and economic conditions can shift rapidly. Tepper prepares for these uncertainties by keeping liquid assets on hand, ensuring that he can weather downturns, meet obligations, and still take advantage of opportunities that others cannot. This approach is a key reason why he can act aggressively when others panic. While many investors are forced to sell or hold back due to lack of liquidity, Tepper has the resources to move with confidence. Liquidity is also essential when balancing the decision between investing and paying off debt. Overcommitting to either can create financial rigidity. Paying off all debt aggressively may leave no capital to seize investment opportunities, while investing all available funds may leave you vulnerable to unexpected expenses or financial shocks. Tepper navigates this balance by maintaining a reserve, allowing him to act on high probability opportunities without jeopardizing stability. It's a strategic balance between security and opportunity, a principle that separates average investors from extraordinary ones. Moreover, liquidity amplifies Tepper's ability to leverage opportunities with calculated risk. When cash is readily available, he can deploy it in ways that maximize returns without overextending himself. This creates a unique advantage in markets characterized by volatility, uncertainty, and fear. Tepper's financial agility demonstrates that liquidity is not just about holding cash. It is a tool for strategic action, a buffer that allows bold moves when the world hesitates. Ultimately, Tepper's insistence on liquidity teaches a fundamental lesson: preparation is as important as action. By keeping a financial cushion, you gain the freedom to act decisively, exploit high-value opportunities, and avoid being trapped by commitments that limit flexibility. Liquidity empowers courage, enhances strategic options, and ensures that when the moment is right, you can strike decisively. In Tepper's philosophy, cash on hand is not idle. It is potential power and the ultimate tool to create extraordinary financial outcomes. David Tepper's approach to personal finance and investing goes far beyond simply eliminating debt. While paying off liabilities is important, it is merely the foundation of a much larger strategy, growing assets exponentially over time. Tepper thinks in decades, not months. He understands that short-term actions, whether paying off debt aggressively or chasing quick investment gains, are only valuable if they serve the long-term goal of building enduring wealth. For him, financial success is measured not by temporary relief or short-term wins, but by the ability to accumulate and grow assets in a way that compounds over years and decades. This long-term mindset fundamentally changes how decisions are made. Tepper doesn't focus solely on eliminating every liability immediately or maximizing instant returns. Instead, he evaluates each financial choice by its potential to contribute to exponential growth. Paying off high interest debt may be necessary because it removes a guaranteed drag on wealth. But low interest debt can be leveraged strategically to accelerate asset accumulation. Investments are not judged by their short-term volatility, but by their capacity to compound wealth over time. This perspective allows Tepper to think strategically, weighing the opportunity cost of every dollar spent, whether toward debt repayment or investment, against decades-long outcomes. By focusing on exponential asset growth, Tepper also prioritizes opportunities that others may overlook. He looks for undervalued investments, distressed assets, or temporary market inefficiencies that, when leveraged correctly, can multiply wealth far beyond conventional strategies. This requires patience, discipline, and a willingness to act boldly when conditions are favorable. For Tepper, financial decisions are rarely about immediate gratification. They are about positioning oneself to maximize returns over the long horizon. The ability to delay short-term comfort in exchange for long-term gain is a hallmark of his mindset. This philosophy also underscores the importance of compounding. Every dollar invested wisely has the potential to generate returns that feed into further growth. Tepper treats wealth like a machine. The more capital is strategically deployed and reinvested over time, the faster and larger the exponential growth becomes. Paying off debt removes obstacles that reduce this compounding power, while strategic investing accelerates it. By balancing both, Tepper ensures that every financial move contributes to building long-term wealth rather than providing temporary relief or satisfaction. Thinking decades ahead also cultivates resilience. Tepper knows that markets fluctuate, crises emerge, and unexpected challenges arise. A long-term vision allows him to maintain focus and discipline through volatility. While short-term losses or delays may occur, the broader trajectory is upward because the strategy is designed for exponential growth, not momentary performance. This patience and perspective distinguish Tepper from investors who react emotionally to every market movement. Ultimately, Tepper's philosophy teaches a vital lesson. The ultimate goal of financial management is not merely to eliminate debt, but to create lasting wealth through exponential asset growth. Decisions should be guided by long-term impact, strategic leverage, and disciplined reinvestment. By thinking in decades, not months, and prioritizing compounding and growth over short-term comfort, Tepper demonstrates how ordinary financial actions can transform into extraordinary wealth. Success is not temporary, it is enduring, intentional, and built to last. David Tepper's success as one of the world's most formidable investors is built on a simple yet powerful principle: wait, study, then strike. He understands that opportunity is often fleeting and timing is everything. Unlike those who act impulsively or let emotions dictate their financial decisions, Tepper approaches every move with patience, analysis, and precision. He waits for the right moment, studies the situation thoroughly, and then acts decisively. This disciplined approach allows him to maximize returns while minimizing unnecessary risk, turning careful observation into extraordinary results. Waiting is not inaction, it is preparation. Tepper spends considerable time understanding the markets, industries, and assets he targets. He monitors trends, studies financial statements, and analyzes economic indicators to ensure that every potential move is supported by data. This period of observation allows him to anticipate shifts in market conditions, identify mispriced assets, and assess the broader risk environment. By waiting, he gives himself the advantage of knowledge while others are rushing or panicking. This patience is a cornerstone of his strategy, teaching that timing, insight, and preparation are far more valuable than impulsive action. Studying is the second pillar of Tepper's approach. Analysis goes beyond surface-level numbers. It involves understanding the underlying drivers of value and risk. Tepper evaluates not just potential returns, but also the factors that could impact them: interest rates, company fundamentals, market sentiment, and economic cycles. He weighs different scenarios, considering both upside potential and downside risk. This thorough study ensures that when he acts, it is with confidence and clarity, not guesswork. For Tepper, knowledge is power, and rigorous analysis transforms uncertainty into actionable opportunity. The final step, striking, demonstrates the courage and decisiveness that separates successful investors from the rest. Once Tepper has evaluated the risk versus reward, he does not hesitate. He commits fully to the chosen path, understanding that hesitation can result in missed opportunities. This decisive action is amplified by the preparation and study that preceded it. He strikes not recklessly, but strategically, with full awareness of potential outcomes. Tepper's philosophy teaches that preparation without action is wasted effort, just as action without preparation is reckless. True financial mastery comes from the combination of both. This principle applies equally to personal finance, investing, and debt management. Whether deciding whether to pay off debt or invest, you must first evaluate the situation thoroughly. Understand the costs, benefits, risks, and opportunities. Wait for the moment when conditions align in your favor, then commit fully. Indecision or partial commitment dilutes the impact of your actions. Tepper's approach shows that bold, informed action is far more powerful than cautious hesitation. Ultimately, Tepper's wait, study, then strike philosophy is a lesson in discipline, courage, and strategy. By combining patience, rigorous analysis, and decisive action, you can navigate uncertainty, maximize opportunities, and take control of your financial future. When you evaluate risk versus reward carefully and act without hesitation, you transform potential into tangible results, building wealth with precision and confidence. In Tepper's world, preparation meets opportunity, and decisive action turns strategy into extraordinary success. Debt or investment, it's not about fear, it's about strategy. Think like Tepper: prepared, patient, and relentless. Make your money work harder than your worries, and when the moment is right, strike with confidence. The choice you make today could define your financial legacy.